welcome to the third lesson of the Market Investing course. In this lesson, we'll look at the fundamental and the technical analysis. Before we get into the lesson, I want to warn you that from now on I will start using investing terms that you probably won't have heard before. So each time such a term comes up, I will pause the video, like right now, to provide you with an explanation. However, in order for you to get the most out of watching these lessons, I would recommend taking notes on what those terms mean so that you can look them up again as the course progresses and those terms come up again. First, I'll explain what the two types of analyzing are, and I'll go a bit more in depth about each of them. And then, in the end, I'll mention a third, better way of analyzing. Let's start with the technical analysis, as it is the easier one to explain. A technical analyst will base all his reflections on charts and graphs. So that means that by reading charts and graphs, he will try to determine when to buy and when to sell a stock. The first strategy we'll look at is the moving averages crossover strategy, and it is probably one of the most famous ones. As you can see behind me, I've drawn the graph of the SMI, the Swiss Market Index, which is the equivalent of the S&P 500 we looked at in the last lesson for Switzerland. And there's a time from 2006 to 2014 time, and price from 4,000 to 9,000 Swiss francs. Now, in black, there's the SMI. In red, there's the 50-day moving average, and in green, there's a 200-day moving average. Now, a moving average is the average of the last 50 or 200 days. So at that point, the moving average of that would be the average of from there to there of the black graph, which would be about there. So you see, that's 50 days, that's the moving average, and as you can see, it always lags a bit behind. Due to a 100-day moving average, lags more behind than the 50-day moving average. In the next part, I will use the term price momentum. Price momentum is a phenomenon that when the price of an asset rises or falls above or below a certain threshold, it tends to carry on in that direction. It is not clear as to why this is. However, behavioral finance has a theory that might be a good start. If the price rises, more people will buy that asset as they are attracted to the rise. As they buy the asset, the price increases even more, which creates a positive feedback loop until it's broken. The same could be said of falling prices. The moving averages technique is very easy as it gives you 100% clear buy and sell signals. Let's go to the graph. So, when the 50-day moving average goes above the 200-day moving average, that means the price momentum is going up, as the past 50 days have performed better than the past 200 days have. So right there, that would be a buy signal. I've already drawn that one there. If the 200-day moving average goes above the 50-day moving average, or otherwise the 50-day moving average goes below the 200-day moving average, that means that you would have to sell. Now, obviously this technique always lags a bit behind because it's using averages of the past. But if you apply it to the whole graph, you can see that you would have performed quite well. You would have probably bought around there. You would have done some uses buying and selling there, but doesn't really matter. Then you would have sold there for a big profit. Then you would have bought almost at the beginning of the rise. You would have sold there, bought there, sold there, bought there, and still be holding it. So you would have made that amount of profit from there to there, from there to there you would have made from there to there, that's quite similar. But then also you would have made profit from there to above. So as you can see, it works for that graph, even though it lags behind. For the purpose of informing you, I will show you two more technical strategies. The first one is a channels pattern recognition strategy. So there's a channel patterns, the upwards, the downwards, and a horizontal channel. There's just the upper wall and the lower wall drawn, there's both. And now that strategy is very easy as it just assumes that if the wall is broken upwardly, that means that trend will continue because it has momentum, and therefore you should buy. And if the wall is broken in the downwards direction, then that just means you'd have to sell because the trend means the momentum will go downwards. The second strategy is called the head and shoulders strategy. Now this is called that way because there's the head and there's the shoulders, and that would make a human bust. Now, to get this pattern, there are 5 assumptions that are made. The first one is that well-informed investors will buy into a position that seems like it's promising. Then, as soon as the price rises enough, those investors will sell out. The sinking of the price will make it difficult for other investors who still own the stock to sell it. So after a while, it'll pick back up, get to a new high. Now at this new high, the investors will understand that it becomes speculative, so they will sell out, which explains the sharp drop. And then once it reaches this point, new investors will see this as a potential good bargain because the price will be very low compared to before. They will buy it, which shoots up the price once more before they sell out too when they're satisfied with their gains. And the figure will be complete once that distance, once the fall is 3% from the shoulder's top. Sorry, that way. The fundamental approach is slightly more vague than the technical approach. It is most famously advocated by Benjamin Graham in his book The Intelligent Investor, and the most famous user would have to be Warren Buffett. Now, a fundamental analyst will look at the present value or intrinsic value of a security. To determine the present value is quite a tricky and ambiguous job. There's more than one way of doing it, depending on which school of thought you belong to. Now, Warren Buffett describes his way of finding the intrinsic value of a stock as taking all the tangible assets.
Tangible means touchable. So a tangible asset is something you can physically touch, such as a factory or a building.
And add what you think the intangible assets are.
Intangible assets are assets that can't be touched, which would be, for example, the brand recognition of a company. Warren Buffett tries to find the real intangible assets, so he doesn't simply use the intangible assets that the company reports they have, but he finds them by himself.
Now, the tricky part is finding out what the intangible assets are. And once he's got that, he will compare the tangible and intangible asset, so its present value, to the market capitalization.
The market capitalization, or market cap, is the valuation of a company by the market. It is calculated by multiplying the amount of shares of a company and the price of one share on the market.
And if the market cap is larger by 25% or less, then he will define the company as a value company, and in that case, he will look at the company and see if it's worth investing in. Well, that sounds simple, doesn't it? Well, sadly it's not that way, and that's what makes Warren Buffett such a unique genius, is that he is terribly good at estimating the present value of a company. But let's not get ahead of ourselves, as we will look at how to analyze a company more in depth in the 3rd chapter, which is about stocks. Now, of course, determining the present value of a company isn't the only thing the fundamental analysis has to offer. So depending on how you define present or intrinsic value of a company, those things are already included, but for the purpose of the lesson, we will separate them. So you might look at, after having found the intrinsic value, some key ratios, the growth of returns, business cycles, and dividends, and some other factors. Now don't panic if you don't know what they mean, as we will look at them in the near future of the course. My opinion is that both the fundamental and the technical analysis should be complementing each other. The foundation should be the fundamental analysis. However, the company-specific like trends that have been provided by the technical analysis should be used to confirm what has been said during the fundamental part. More details on how to analyze companies will come later, but keep that as the foundation for the market investing strategy. So, what did we learn in this lesson? We looked at the technical analysis and the most famous strategies for it. Then we looked at the fundamental analysis, very roughly how Warren Buffett does it, and we looked at other factors that are relevant to it. And most important of all, we learned that both types of analyses should be complementing each other. Thank you for watching this lesson all the way to the end. I would appreciate it a lot if you shared this lesson or this course with anyone who you think would benefit from it or would be interested in it. And see you very soon in the 4th lesson of the Marmot Investing course.